It goes up in layers and then it jolts and in a new reality. Silver's about to enter that new reality. And we know its fundamentals. We don't focus on that, but we know that they've been tight for years. They get tighter. Industrial demand is continuing to rise because of solar and the solar cell stuff. And also AI is creating a lot of demand because silver in micro forms is used throughout the whole system. And yet supply is not increasing. Silver has a unique fundamental game. The question is, when is it going to do it? We think it's begun.
And you don't have a timeline specifically associated with that?
I think most of the profit-making phase of the shift, the easy part, is when that spread breaks out.
Okay.
And yes, I think it could be this month.
In his latest interview, market technician Michael Oliver outlines what he believes could be the most decisive turning point for precious metals in decades. His framework is rooted not in short-term speculation, but in long-term structural dynamics, the kind that define multi-year bull markets. According to Oliver, silver is standing on the edge of a new reality, one shaped by both tightening fundamentals and an accelerating technical breakout. Industrial demand from solar production, artificial intelligence hardware, and electronics continues to surge, while supply growth remains flat, largely because most mined silver is a byproduct of base metals like copper, lead, and zinc. The miners responsible for this output have little incentive to ramp up production based on price alone. This asymmetry between demand expansion and inelastic supply is setting the stage for what Oliver calls the acceleration phase, the period where most of the price move happens in a short span of time. Gold, in his view, has already confirmed its long-term bull structure. Having risen steadily from its 2015 low near $1,046, Oliver projects that the next stage of this move could take prices toward $8,000 to $8,500. He bases this on the logarithmic rhythm of past gold bull markets, both of which achieved roughly 8-fold gains from trough to peak. The present macro environment, dominated by sovereign debt crises and fiscal overextension across major economies, presents far more explosive conditions than either of those previous runs. What makes this period distinct, he argues, is the absence of any visible technical ceiling. Momentum indicators remain intact on annual and monthly timeframes, suggesting that gold's long-term structure remains sound even if the market experiences near-term volatility. While gold commands attention as the bellwether of monetary stress, Oliver's emphasis is now firmly on silver, and with good reason. Historically, silver has moved with gold, but has also demonstrated a tendency to outperform sharply in the late stages of each cycle. The key signal he's watching is the gold-to-silver spread, which currently hovers around 1.125%. Should that spread break decisively above 1.31%, Oliver argues, it would trigger the same explosive dynamic seen in 1979 and 1980, and again in 2010 and 2011, when silver went from $28 to $50 in a matter of months. A structural signal that silver is no longer following gold's lead, but commanding its own trajectory. Once that breakout is confirmed, the silver market could reprice violently higher, first toward $100 and then potentially $200 as the gold-to-silver ratio normalizes toward historical norms of 2 to 3%. This isn't a speculative target pulled from enthusiasm, but a continuation of the patterns seen across decades. When base commodities such as copper, lead, and even beef transitioned from decades-long price stability into new pricing plateaus, the revaluation happened swiftly and permanently. Silver, Oliver says, is the one major commodity still trading within its 50-year range. Its transition to a higher equilibrium would not only be overdue, but also irreversible. For investors observing this development, it's critical to recognize the significance of these structural setups. The technical evidence, momentum alignment, and macro conditions all point toward a convergence few markets experience in real time. As silver approaches its breakout threshold, the window for accumulation narrows. This is the phase, Oliver suggests, where positioning early offers exponential payoff potential once the acceleration begins. To stay ahead of that curve, subscribe, stay informed, and follow our ongoing coverage as this historic transformation in the precious metals market unfolds.
Let's start with gold. Obviously, it's just on a rip every day, new all-time high. Where do you see it going?
Well, I'm not sure where it's going, but I suspect there's one level it'll at least see, and that's 8,500 area on gold. Now, there's a couple charts I sent you. And the first chart shows a logarithmic scale, a ratio scale chart of gold going back to 2015, 1975, excuse me, when the federal government allowed us to own gold again. Okay.
Yeah.
That was very nice of them.
Very kind.
Anyway, we've had two major bull markets in that 50-year span with external conditions that are nowhere near the dynamite conditions we've got in terms of factors that could drive gold. Both were 8-fold moves in price, bear low to bull high. No matter what the price, the different duration trends. One was about 3 years, one was at 10. Okay. But the moves were the same, 8-fold. Our bear market low, last one was $1,046, $1,050 in 2015. Okay, we're only halfway the dimension of the upside of those two prior bull moves. You can see it on the log scale chart at the top, which is the gold chart. If we were to match those two moves, just don't say we're going to do it again, okay, good, 8,000 plus gold. Okay, now that's just compared to the old bull market peaks. Now, it may not stop there because these factors we're talking about are horrendous, especially government debt, not just here, but Japan, elsewhere. Yeah. That game is yet to explode in terms of its real world consequences. Mm-hmm. My own personal assessment and portfolio is emphasis on silver now. Okay. Silver moves with gold, but it sometimes lags, sometimes outperforms. Usually it lags. Now, this year it hasn't. It's actually up more year to date than gold is by a couple digits. Okay, so it's significant this year. But historically, it's still very low relative to gold. Like silver's trading at 1.125% the price of gold right now.
Mm-hmm. We do 80 to 1? So it's still 70
no, we don't do it that way. We divide an ounce of silver into an ounce of gold, express it as a percent. And if you go back over that 50-year span of time, we don't show it here, but silver in 21 of those 50 years that we've had has at least been 2% of the price of an ounce of gold, minimum. And in bull trends, like 79 to 80, or we're in a bull trend now, right? Okay. Yeah. Or in 2010 and 11, silver was 3% or more the price of gold. So right now at 1.125, silver is very cheap relative to gold, but it's technicals of that spread relationship. And we study it, week by week, month by month, and we run momentum of the spread. Momentum is now breaking out. It's telling us the spread itself that is rising, favoring silver since the beginning of the year, or especially since April, by the way. No, since April, sharply. It still hasn't broken out on the spread, but the spread, you get above 1.31% to get bean counting for you. Yeah. And we're headed toward that level. You're going to blow out like a 3-year high on the spread, in which case you're going to go. You're going to rush. Why is that important? That is the prominent indicator back in the 1979 to 80 surge, this final 6 months of that move. Silver had already been going up for years, so had gold. But suddenly in in summer of 1979, that spread broke out of a situation it looks just like now. In other words, a potential breakout level, silver versus gold. It's at that point that the net price of silver, not just its relative performance, went boom off the page. I mean, it left gold behind. Gold was still rising, okay, but silver just went whoosh, okay. Exact same thing happened 2010. Like in September of 2010, silver had already been rising for years, so had gold. The spread broke out again. Said silver's, I'm back, okay. And by April of 2011, silver had gone from 28 bucks to 50. From that point, we're at that cusp right now, where if you go through that level that I just mentioned, and
1.
we're nearing, 1.31, you get above that, there's a vacuum between you and 2%. And that's not necessarily resistance. That's just a level we've been at 20 of the past 50 years, okay? So it's hardly exciting to get there. Yeah. But that is enormous. So that's why I'm emphasizing silver, because I think silver is vastly undervalued. And you could even see it on the price chart I've got there.
Yeah. Yeah. And we'll show that chart. Yeah. I mean, is that how you know when to start taking profits and when to sell?
No, it's when if you're not in, where to initiate positions. Okay. I'm already in, and our subscribers have been handheld for the last years. We got bullish in February of 2016, 2.5 months off the bear low. Annual momentum of gold and silver said, it's over, I'm going back up. Nothing has changed the annual momentum of gold and silver, very long-term trend metric, okay? Mm-hmm. Nothing has altered that view. So it's been an ongoing bull for 10 years. And we're now at the point, I think, where the acceleration phase, the dramatic phase, where half the move occurs in 6 months, is about to occur. And I think for silver, it's likely to take us at minimum, I'm talking like sometime in next quarter, first quarter of next year, to 100. And if, on the other hand, in the first 3 months, don't be shocked if this happens, meaning acht nov dies, okay, if we get up near 100 then I think we're going to about 200. And
wow.
No, it's not insane.
Because I mean, gold would be at 5,000-6,000 at that point.
Gold might be 8,000 by then, but if silver were 2% of $8,000 gold, let's say gold does the routine again. Okay, 2% of that's 160. Is that right? Yeah. Okay. I mean, you get the point. But also, when you look at the silver chart, it's very important because that log scale gold chart, I've got this red arrow going up over the 5 decades. It's been wave after wave, but higher and higher and higher. Silver, you could draw a line sideways through 1979, and we had 2 peaks at 50. We're only marginally out above that now, and so it's been caught in a 50-year range.
The evidence supporting this transition is as compelling as it is consistent. Gold's annual momentum remains deeply entrenched in a bullish formation, with no structural resistance within reach. Silver's spread momentum, the ratio of silver's price relative to gold, is breaking out on weekly charts, reinforcing the case that silver is set to outperform. Oliver likens this to the late 1970s, when both metals had already been rising steadily for years, before silver abruptly detached from gold's pace and soared higher. In technical terms, once the spread crosses its breakout threshold, the ensuing rally often compresses years of gradual gains into months of sharp revaluation. This pattern reflects a fundamental truth of market dynamics. Acceleration phases are born not from new information, but from the market finally pricing in long-known realities. Silver's structural constraints, its status as a byproduct, the lack of responsive supply, and rising industrial usage have been visible for years. Yet markets tend to ignore such conditions until momentum forces a reassessment. When that moment comes, the repricing is swift, often extreme, and always transformative.
Once it goes through that 2%, to 3%, it doesn't last long up there. That's kind of what I meant.
That's the question. And this is what we're arguing. We think this is a shift to a new reality and price level for silver, meaning when you move out of this zone we've been in for 50 years, okay, and you go to $100, $200, you're not coming back to 50. You're going to live in a new range. Yeah, there will be sell-offs in that range, but the level has got to be sought out first. And frankly, you can look at a monetary degradation issue, like you mentioned, the money supply increase. Well, if you compensate for that, we'd be $200 easily. Okay. But there's some other charts I've included too that sort of smack you in the face. The next set of charts that I sent is 3 simple, stupid commodities. Okay. These charts are all from the Federal Reserve of St. Louis, Fred. Okay. Yeah. And one is the top chart is the price of lead. Okay. Going back to the late 1980s. In fact, you could go back to 1980, and you'll see that the first phase of that price action is the arrow on the left at a very low level. It just goes for decades sideways. It sort of looks like silver today, where it was in 1980, okay? But look what happened to lead. It just suddenly went boom and quadrupled in price, not because of a crop failure. Okay, we're talking a base metal here. Now, wheat can explode because of a crop problem, but, a base metal doing this. And by the way, other metals did the same thing around that time. But it went to a new reality. And yes, then it dropped off again. But look at the new reality that's prevailed since then on the lead chart at a much higher level, horizontal for decades. Silver's still in the first range. Okay. Then the second chart's copper and copper products, as the Fed calls it. They incorporate products of copper. Same story. Multi-decade range at a given level. Then suddenly within a matter of about 6 months, you move into a quantum, to a new level, and you go sideways again, but at a whole new reality of price. And now copper's at all-time new highs, above even the 2011 high, which silver has only just done. Okay. The bottom chart is beef. Okay. Pound of beef. Okay? Look at what it's done since.
Don't get me started. Go to your butcher.
It goes up in layers, and then it jolts, and then a new reality. Silver's about to enter a new reality, and we know its fundamentals. We don't focus on that, but we know that they've been tight for years. They get tighter. Industrial demand is continuing to rise because of solar and the solar cell stuff. And also AI is creating a lot of demand because silver in micro forms is used throughout the whole system. And yet supply is not increasing. In fact, silver has a unique attribute in that most of the silver that's mined does not come from silver miners who are motivated, of course, by a rising price of silver. They come from people that mine magnesium or lead or zinc or copper. So, it might be a marginal issue for them to increase silver production because, frankly, it's just a byproduct of their copper production, et cetera. So they're not motivated by rising prices. Silver has a unique fundamental game. The question is, when is it going to do it? We think it's begun.
And you don't have a timeline specifically associated with that?
I think most of the profit-making phase of the shift, the easy part, is when that spread breaks out.
Okay.
And yes, I think it could be this month. Frankly, this week, if you close where you are now, the spread momentum is already breaking out on a weekly basis. But when you go to a monthly close, we wait for the end of the month. And if you're above that 1.31% level by the end of this month, which is no big deal, we could be there in 2 days, okay? Count on it. Assume that, launch just began via this spread metric. Price is already in acceleration. That's fine. But the point of going crazy was defined in 79 and 2010 by this spread. And I think we're on the cusp of that. And that's where in the next literally handful of months, most of it occurs.
Incredible. And where do you see the buying come from? Do you look into that? Do you care so much about that? Not really.
I frankly don't care. We see these CFTC reports and we hear these stories about this, that, or the other shortage in this exchange and so forth. That's all just facts of reality. They've been out there already. They're now just getting more accentuated. And those aren't necessarily good timing mechanisms for when to buy or sell. Those are just factors in the background that have been percolating already. And the point where they go to boil is when the spread breaks out, is what we're arguing. And I just think silver is going to do what's sort of normal. In other words, it made a mistake. You look at those charts that we showed there. How come you go from level A to level D in a matter of 6 months? Obviously, the market had not discounted something properly and suddenly said, I got to price that in. Well, probably the factors that caused that move were already known. The question was when.
I think I kind of asked you this before, Michael, but is there anything that would invalidate your bullish thesis on precious metals? I mean, it's hard to imagine.
There's nothing technical. Normally when gold tops, and by the way, we got bearish 3 months after the high in 2011. In January 2012, we turned major bearish on gold. It labored. Now, it made a high at 1,920 in October of 2011. Dropped down to the 1,600 zone, 1,700. We got bearish, and it went sideways for that year, 2012, up and down, sort of like the teasing stock market. It just wouldn't go down, yet we stayed bearish.
Yeah.
It tried a couple times to make a new high, went up to the high 1700s. We never could get back to that high. But annual momentum had broken a massive trend structure shortly after making the high in October 2011. Price didn't break anything at that point after that pullback. But momentum blew a structure that your jaw would drop seeing the clarity of it. Okay. At the bottom, 2015, price had already collapsed, but was still staircasing down at a more gradual level on gold and silver and the miners. But momentum had built a huge ceiling, annual momentum, that was so clear that it wasn't clear on the price chart because it was lower highs, but a momentum was like a ceiling at the same level for 2 years. You pop through it in February of 2016, after the 2015 low. And you exploded up to 1,300. So you started the bull market. The structures were near the market when it turned both of those times. That's the point I'm making. There's no structure near where we are now on momentum that says if you have a drop of $200 in gold or 500 or anything, you're not even near any.
Yeah, you're so far above the line.
Above any momentum vulnerable structures that say it's over. Momentum almost always will break a clear structure before you see the evidence on price. Right now, we don't have that situation. I'm betting by the time you get the structure close to the market, meaning where the momentum factors come up under the feet of the market, we're going to be at some level that you could throw a dart, but we're not near that. So there's nothing that I can see on long-term momentum that says you got any problems. It's the other way around.
Right.
If you're a doubter and wanting to take profits, you got a problem.
If silver does achieve this revaluation, it will mark the end of a 50-year price regime. Once prices move decisively beyond the $50 range, the market won't revert to old norms, just as copper, lead, and other base metals never return to their pre-breakout levels after moving into new realities of pricing. A sustained move into the $100 to $200 range would not represent a speculative overshoot, but rather a permanent structural adjustment reflecting both monetary degradation and the real costs of supply scarcity. This would align silver with other commodities that have already undergone similar realignments in the last 2 decades. Gold's trajectory complements this narrative. As global debt burdens escalate and fiat credibility weakens, gold's role as a monetary benchmark will likely strengthen, driving institutional flows back into physical assets. Oliver's projection of $8,000 to $8,500 is not merely theoretical. It's consistent with the scale of prior secular bull moves adjusted for today's fiscal extremes. The correlation between monetary expansion, real asset revaluation, and investor rotation is becoming increasingly pronounced, suggesting that both metals are entering synchronized acceleration phases. Beyond the technical and fundamental case, the psychology of this shift cannot be overstated. Precious metals markets have spent years underperforming despite clear monetary deterioration. When silver finally breaches its technical threshold, that skepticism is likely to convert rapidly into urgency, a behavioral shift that fuels the parabolic portion of bull markets. Investors who understand this phase as structural, not speculative, will be positioned to benefit most as capital rotates toward hard assets. In an era defined by rising debt, persistent inflation, and currency debasement, Michael Oliver's analysis provides a disciplined framework for identifying where genuine, non-inflationary value still exists. Gold and silver are not simply hedges against uncertainty, they are becoming repriced measures of stability in an unstable financial architecture. For those who track these markets closely, this is the moment to pay attention. Stay subscribed, stay informed, and watch as the next chapter in the precious metals story begins to unfold, possibly sooner than anyone expects.